today this morning in the UK time, you will start to list on the LSE, and our CDIs will commence trading tomorrow. So we've just completed an IPO process. I'm more than happy to sort of talk you through some of those sorts of things as well. Maybe just to recap, what's the proposition with Clydesdale Bank, given that it was spun out of National Australia Bank, and for much of its time there was a pretty much unloved asset. So why should people actually want to hold this stock? Maybe just to give you a bit of an overview of the franchise itself, we have a very large existing customer base. We're not a bank that's being built, it's a bank that already exists. We've got about 2.6 million retail customers, 200,000 SME customers. So we've got a fairly substantial market share in the markets that we are operating in. And as a result of that, we have got also a very long established footprint. We've been in operation in Scotland for over 175 years and within Yorkshire for 150. Reputationally, we've actually survived the GFC in terms of we were not a bailed out government bank, and a lot of the bigger guys are suffering reputationally as a result of that. We've still got two large banks in the UK that are government owned, RBS and Lloyds, and as a result of that, we've got a very strong and loyal sort of customer base in our core markets that are very parochial towards the Yorkshire brand and to Clydesdale. We rate very well in terms of the Customer Trust and Confidence Index. The YouGov polls, which are kind of the equivalent of the Nelson type polls here in Australia, consistently show us well above all the majors and tracking in the top quartile in terms of the challenger groups. The other thing probably just to point out, because we've been in existence for quite some time, we're not trying to build anything new. We've got a very established branch network, we've got a very established internet banking platform, telephone banking, etc. All the things you'd expect from a bank that has been in existence for a long period of time. We're not looking to create anything new, we are actually looking to consolidate what we have. And I suppose then, so what does this mean in terms of the way that we are going to start life? Some people could be critical of NAB in terms of sort of saying, well, it was an unloved subsidiary on the other side of the world that wasn't particularly well managed. Some of that may or may not be true. The thing I want to sort of just spend a bit of time on is the fact that NAB has actually, and through its shareholders, have actually invested quite heavily to get this business ready for sale. So what does that actually mean? We are a business that will start life in a very strong balance sheet position. We have got a very strong core equity tier 1 capital position as well as a total capital position. Core equity tier 1 is going to start at 13.2%, well above our sort of target range and in line with the stronger banks in the UK. We are particularly well funded. We are broadly fully deposit funded, and a lot of our asset growth is actually supported by strong deposit growth. Now, the deposit growth is very much delivered through our strong branch network, and that has been an excellent vehicle to gather deposits in our heartland. It also gives us a very low cost of funds for the group, which is sort of sits below 1% on an aggregate basis. So the balance sheet starts life very well. The other two things just to point out in the balance sheet, very strong asset quality. Now, part of that's probably due to the economic cycle. Unlike Australia, the UK went through some reasonable challenges over the last probably 5-6 years, and a lot of the excess both in middle SME type lending as well as parts of the housing market got really sort of shaken out through asset price deflation and a number of excesses being cleared out of the system. So we currently have a cost of risk around 21 basis points, so that's basically the P&L charge to gross loans and acceptances. The underlying level was 16 basis points, but we also had a collective top-up during the last 12 months. We think that normalises for our sort of size of book currently around 30 basis points. So through the life of, or through the cycle, we think it's probably a bit higher than where we currently are, recognising that we are in a relatively benign environment. The other thing that underwrites the risk on the balance sheet is the conduct mitigation package that NAB have put in place. So this is the additional 1.1 billion of sterling of insurance, I suppose, best way to describe it, to deal with any sort of legacy issues. We have on the balance sheet $1 billion in terms of provisions that will sort of deal with known issues, and NAB have got another $1.1 billion in relation to potential future matters arising. Now, just to put that in context, we have spent well short of that, the $1 billion in terms of dealing with PPI and some of the other conduct issues year to date. And that's from 2009 onwards. So we have not yet spent anywhere near that sort of money. So we believe we've actually sort of reasonably well provisioned. And also the other thing probably to note is the regulator in that market would not necessarily look to have a parent with deep pockets exit ownership without ensuring that there was a reasonable level of cover and insurance available to this franchise. I suppose then sort of just a couple of other things. We have a full-scale banking platform. We are not looking to be creative. We're not like a TSB or Williams and Glyn that still rely on their either current mothership or their previous mothership to provide their IT platform. We are pretty much fully standalone. So we are ready to go. And this is a platform also that used to support two other banks when we owned the two Irish banks before they were sold to Danske. So the balance sheet is quite strong. So, why is this stock going to come to market below book? And I'll talk a bit about the pricing range in a minute. The reality is, from an efficiency point of view, we are woeful. There is no two ways about it. Management absolutely recognise that a return on equity of 5% is not appropriate, and we do need to get to at least our cost of capital, if not more, particularly for Australian investors that are used to investing in stocks that have ROEs much stronger than mid-single digits. So, and also from a productivity point of view, our cost-income ratio at 75% is, way out of the market. Some of the stronger challengers, or some of the stronger banks, I should say, in the UK are currently sitting at 55%. So that's, quite a bit lower than where we are. Now, in our cost guidance, some of you will remember that we said our intention is to come to market, in 5 years' time with a cost-income ratio below 60%. Now, we do recognise that even 60% will not necessarily make us competitive at that point in time, because our peer group will have well and truly moved on. Recognise the targets for what they are. They were developed as we were sort of changing a number of our senior management team. There is work that is ongoing at the moment. We'll sort of continue through the course of this year to see what further work we can actually do. So we do recognise that from a cost and efficiency point of view, we are well below where we need to. Just as an example, just on FTE alone, we've got 7,200 people. 3,000 of those are customer-facing roles, meaning 4,200 do not see a customer. Now, that weighting is altogether wrong. So there's a number of things there that we are looking at doing, and a number of our processes are incredibly manual, and so we are looking to undertake a lot of straight-through processing. We've already completed that in terms of our deposit gathering process. That has already been automated, but we still have work to do on some of our other key processes like home lending and SME lending. The other side of it is we do not necessarily think we're going to need to spend a lot more in terms of investment. So we currently spend about £100 million a year in terms of CapEx. The last 2 years we've stepped that up to 150 each year. And that is actually sufficient for a bank of our size to keep our infrastructure resilient and current, as well as starting to invest in initiatives that pay back to the shareholder, whether they be product improvements and product relaunches, improving processes for customers to improve their experience, or delivering efficiency savings. So we're not necessarily looking for a step up in CapEx beyond what we've already described to the market. That is well within our cost targets. Probably the only other thing that I would touch on then is just looking at the way that we can enable customers to interact with us much better than they do. So what do I mean by the omni-channel strategy, which you may have heard us talk a bit about before? It's very much around, customers will walk into a branch potentially to seek advice on something. They might walk into a branch to start a process. They may want to look online. They may inquire through the telephone banking. Irrespective of how a customer sort of starts to interact with us and how they may choose to fulfil it and go through the process, we want to be able to do that seamlessly between all our channels. And so we we are doing quite a bit of work in relation to how do you do that in one way, same way through all different channels. So there's a piece of work also going on internally to ensure that how customers choose to interact with us is done in the way that they choose. So we are doing quite a bit of work there. Ultimately, this business is very focused on returns. Like I mentioned, a return on tangible equity at 5% is nowhere near where we want to be. The first step is to get back to double digit, and that's probably analogous for our cost of capital, but we will not sort of stop there. So a lot of the internal workings within the bank are being rewired to not think about cash earnings or profit, but very much to look at the return profile. In terms of, I might just finish on the IPO pricing. The indicative pricing when we started the process a couple of weeks ago was 175 to 235. You'll probably be aware that that was narrowed significantly to the bottom end of that range. So I think the current pricing range is 175 to 185. The book closed in the UK overnight. And there was an allocation process that happened. NAB, I suspect, will make an announcement sometime imminently in relation to that. And needless to say, we've actually, despite where the pricing has ended up, we've actually had good interest from right around the world. Investors in the Northern Hemisphere, primarily those investors in the challenger bank space, have been quite active and spent quite a bit of time looking at the stock and have done quite a bit of work. The other side of it was we've actually had significant interest in the Australian market as well. So a number of Australian institutions have bid into the IPO process, which kind of surprised me personally. That was not probably my going in position back in September when we sort of started with the early look. Given it was sort of offshore, a million miles away from Sydney and Melbourne, as well as Brisbane, and then not a franchise that had been particularly well run. So people are sort of saying where to from here. But I think as we've sort of taken people through the story and realising that where the balance sheet is at and where the operational efficiency opportunities are and what we're trying to do on the return has sparked a lot of interest. Given where we will ultimately sort of price, and the pricing range at the moment is probably in that around that 0.6 times book type range.